All right, thank you everyone for joining us for our quarterly webinar. As shared in our quarterly letter, CNBC has once again recognized us as the #1 financial advisor in the state of Virginia. We jumped from #9 nationally a year ago and 2 years ago to #3 nationally. So it's quite an honor, and it's a reflection of our 50 years of commitment to our service of our clients. The big news, of course, right now are the elections upcoming. We're less than 3 weeks out. I can assure you that the headlines will be dominated by each poll and all the excitement that goes with that. So if you are one that enjoys that type of news and thrill, I guess, if you will, in terms of having a dead heat election decided soon, enjoy that, but don't expect the outcome of the election to have a material impact on your investments. So Andy and Adam will cover their typical topics in terms of how various asset classes have been performing. Obviously, you've been enjoying the run as most of us have. We've had a really nice run here lately. And then Andy will talk more specifically about how we're positioning to maximize opportunity ahead. So Adam?
Thanks, Lowell. And real quick, before we get into the slides, we've been doing this the past few quarterly webinars. You can scan this QR code with your phone or go to slido.com and put in that unique registration number. But this is the way to submit questions throughout the webinar. We got a really good inflow of questions beforehand, and we'll definitely address those. But we'll pop this up 1 or 2 more times to give everyone a chance to ask questions. Before I do a snapshot of what happened in Q3, I want to first, it's always interesting to look backwards at what has happened the last few quarters and what were some of the topics we covered and how did things pan out on a forward-looking basis from there. And one of the things we talked about in our Q2 webinar was the fact that the year so far and the trailing year had been really quiet in terms of overall volatility. We had gone almost a full year, about 350 trading days, without a 2% or more decline in the S&P 500. And literally about 3 days after the webinar, all of the news came out around what was happening in Japan with the carry trade. We got a really concerning employment report that Friday. And it was a good reminder of how quickly things can change regardless of the information you have at your fingertips. From that point on, we had about an 8% decline top to bottom in the overall market, and have obviously since recovered, as shown by these numbers here. So despite the rough start to Q3, really across the board, most asset classes far exceeded their typical quarterly averages. So on the stock side, U.S. equities continued to perform really well. As part of that, and Andy will touch on it, it hasn't been as top-heavy of a market rally. You've seen some broadening into some other sectors of the market, a game of catch-up, so to speak, which has been really encouraging for some of the overall trends. And then overseas markets, which have been pretty quiet coming out of 2020 across the board, have had a little bit of a resurgence, which is great for diversified investors. And then global real estate and bonds, these are asset classes that were very sensitive to what was happening with the aggressive rate hikes in 2022, coming off of historically really brutal stretches of performance, had some good wind behind their sails as inflation is easing, rates are coming down, and the economy is still strong. So for the diversified investors, this was a really encouraging quarter that kind of reminded us that, hey, it doesn't need to be 7 stocks anymore that drive the totality of our portfolio returns. And stepping back and looking at 1, 5, and 10-year numbers, some of the trends have kind of remained intact. The trailing year, I think, just takes a further look at what's been happening on the equity side with international versus U.S. You've had across the board above average returns. We'll talk about the big question we get, which is how much longer can this kind of run its course? But nonetheless, really encouraging signs globally for stock investors. Bonds have started to bounce back from what has happened the last several years. So, 2022 was a historically poor year for fixed income investors. And, there's just been a loss in confidence to a large degree of, bonds as a really good balancer to the portfolio. But this kind of a bounce back, and with the rates higher, is starting to get people more comfortable with moving out of cash and off the sidelines, at the very least, into higher yielding, longer term assets like bonds. And then, one of the interesting that's, something to keep an eye on is just, if you go back the last 10 years, it's still been a U.S. equity driven market. And that's just been the case. It's been intact in that regard. Even the last 5 years, it's just been geographically just, focused here on the home front. There's still a lot of great encouraging trends that still play in favor of that, such as, just the demographics of our country versus other developed nations, our economy, how we're at the forefront of this huge innovation wave in AI. So a lot of great things to feel good about here domestically. But I think on a valuation case, we're still comfortable with the idea that investors can look globally and across asset classes when trying to diversify their portfolios. So in terms of this recent run, some of the Q&A we got, and the questions, Andy, on the next slide, one of the things that we've been hearing, I would say we've been hearing this from clients almost for the last year. And anytime the market goes on these runs, it's just, hey, is this overheated? Do we need to be concerned about something? What comes next? Do I need to make any changes to my portfolio? So we're going to take two views at this, current bull market versus previous, and try and put some context to it. But these are all of the bear to bull markets that have happened since pretty much since World War II up until today. In here we snuck in a few bear markets that are actually not technically bear markets. The definition of a bear market by the book is a decline of 20% or more. And as you'll notice here, there's been some really, really close calls. So it makes sense to toss them in for consideration, because some of these coincided with, close to recessions or, some really big global events. But you could see the average sell-off, the average bear market is a loss, a sell-off of about, 30-ish%. We were close to that in 2022. We exceeded that in 2020. And then you can see 1 year and 2 years off the lows, what has the cumulative total return been of the market coming off of those, coming off of that bounce and that bottom. So I'd say concern number one for clients has this been a run in the markets that's just been way overheated? Are we in over our skis in terms of how far and wide this has gone? And the short answer is, historically and technically, no. This has been a pretty average bounce off the bottom, looking 2 years back. First year return was actually pretty weak, relatively speaking. So one of the arguments being made in 2023 was, hey, this bounce off of the 2022 sell-off is way too top heavy. It's only a handful of stocks, and it's really not strong enough that other boats are, kind of rising, with the tide. And there was it caused a little bit of not only just pessimism, but just questioning the strength of the market. But then this year we played arguably a really good game at catch up. So this is a pretty average, bull market recovery off of a bear, and nothing that's over euphoric or overextended by any degree. And then on the next slide, Andy, I took the technical bear markets, those that were only 20% declines, and wanted to just kind of show, well, for the actual bear markets that have happened, how long do they historically last? Like, what's the average lifespan of a bull market? And going back to around the World War II time, it's about 5.5 years. So we're 2 years into what's historically been an average, 5.5, year, bull market. Obviously, some are a little bit longer, some are a little bit shorter. 5 of the 12 have started in October, coincidentally, just like this one. I don't know if there's any real rhyme or reason to that. That's just an interesting factoid. But these will start and stop for different reasons. I think overall, there's still a lot to feel good about. You point at things just like, the trend in inflation coming down to below 3%, unemployment at 4%, double-digit earnings growth, an acceleration in earnings growth for some of the mid and smaller companies. You can say you take those, those growth signals, and on top of that, you layer on this wave of innovation that's starting and will be accelerating with AI, and what that might do to just the productivity of the overall economy. And on paper, there's still a lot to feel really good about. So we'll put this with the caveat that as an investor, it's easy to look at these things and feel really confident, but these are also great times to also reassess just where you are in your financial lives and personal lives, what your time horizon is, what kind of liquidity you might need from the portfolio at any point in the near future. So your advisor is there, and this is a great time to have those proactive conversations, because a lot of times the risks to the market and what we want to fear the most is just those things that are not factored in that can come out of left field. COVID was a great example, and there's plenty of other instances where things that are not on paper priced in can come up and cause short-term volatility that we ultimately recover from. So we'll probably get more into this in the Q&A. But in general, great quarter, great year, pretty average start to a bull market. And we're pretty young in the bull market relative to what has happened historically. And then we've got a lot of election questions, and we wanted to go back and plug the webinar that was done at the end of August, specific to just stock market performance in and around the election in different presidential terms. That has been recorded. It's on our website, and we're also going to be emailing that out sometime over the next couple of weeks, but you can get it immediately on our website, berniewealth.com, to view that. It's about 30 minutes of Andy and Beijel going through all various different data points around the election. I wanted to focus on one, and Lola alluded to it earlier, that our stance is, despite who's in office and what happens around the election, our economy and the global economy is much bigger than any one individual, and markets tend to be resilient, look beyond it and look forward, and companies find a way to manage through it. So our general stance is no real impact with regards to the election and the markets over any reasonable period of time. But this is something we shared back in July that I wanted to re-highlight, which is what has happened in and around election years themselves historically. So this goes back from 2020 all the way to the late 70s, various administrations, Republican wins and losses, Democratic, wins and losses, but just what's the average return been in the year leading up to an election, and what's been the return during an election year. And you can see both hovering around 7% on the top right. So the last 2 years have been clearly, we're coming off of a bear market and an almost recession, but we far exceeded the historical average return in and around election years. There's probably not much that relates to the election that the market's not aware of now or potentially anticipating. A lot of these things get priced in. With the 2012 and the 2016 election, just to preface it, what you sometimes see is like the day before or the day after the election, or even over pre-market trading overnight, what's happening in the futures markets in terms of maybe some bigger swings and some volatility, in equity markets and bond markets. That is just general noise that usually doesn't transpire in any kind of theme or issues or anything to really invest or make a decision based off of. So that's our stance. I think that webinar is a great resource, and a lot of great points are covered. So that's on the website, and will also be emailed out within the next couple of weeks.
Yeah, appreciate the plug, Adam. This is just one of 8 surprising facts that we talked about in that webinar. So definitely go check it out on the resources side of berniewealth.com. Moving on, though, to our investment strategies, I think the biggest news that we got in the third quarter was that the Fed finally cut interest rates after this prolonged period of raising interest rates. And really, I think this is a major milestone that probably should be celebrated because it marks a turning point in the Fed's battle against inflation. And I think it really reflects the progress that has been made really to beat it back. As Adam mentioned, the concern kind of shifted from around inflation to around the jobs market and the economy. Was the economy slowing too much? Was the Fed being overly restrictive with their interest rate policy? So that was some of the concern that was going in, and it really was the reason why the Fed cut not 25 basis points, but half of a percentage point. I think that's the Fed communicating to the rest of us that they do think they have their arms fully around inflation. And so while I do think it's maybe a little bit too early to declare victory, it sure does seem like they're pulling off this soft landing that has gone from inevitable to impossible and everywhere in between over the past couple of years. Really the rate of inflation is maybe slightly elevated to normal now. It's certainly not the emergency that it was in 2022. And, something the Fed, though the concerns about the Fed being too restrictive, as I mentioned earlier, have sort of been put to bed a little bit because the most recent GDP readings and the GDP nowcast that the Fed puts together, along with the most recent employment report, point to a more positive situation. So I think, given that backdrop, I think the major question for investors, though, when it comes to the Fed's interest rate policy is how will this rate cut impact stocks? And so while I do think that the rate cut is important, it's really not the cut itself that's the piece that the market's going to care about. It's the reasons why the Fed is cutting rates. Goldman Sachs reviewed the past 10 rate cut cycles, and they categorized the reasons for the rate cuts into 3 categories. One, because a recession actually occurred and the Fed was cutting rates to stimulate the economy. 2, there was a growth scare, so the Fed was concerned about the possibility of a recession, but the recession never materialized. And 3 was simply normalization of rates from a higher level back to what would be considered a more normal level for the Fed. And over these 10 periods, 4 of them, there were recessions in 4 of them. There were, normalizations in 3 of them, and it was a growth scare in the last 3. And I think the really interesting thing that this chart points out is that heading into that first cut, the market really doesn't do a very good job of differentiating what state we're going to be in as an economy. If you look at the average returns heading into that first cut, they're really not that materially different. But once that cut happens, then it really does matter, what's going to happen next. In those periods where there was a recession, we saw the stock market really begin to sell off and stay, pretty low for, 2 years. But in those other 2 situations where you had the growth scare or the normalization, the market made material gains and kept going higher and higher through the 2-year period afterwards. And really, I think it doesn't matter that it was a normalization or it's simply a scare. You see very similar looking price charts, going back for those 6 scenarios. And so this is really where we are now, where the vertical line comes down in the chart. We're sort of at this inflection point. So the question for how is the stock market going to do from here, it really comes down to, are we going to see that recession? Is it going to simply be a growth scare or simply a normalization of rates? I think those are the things to watch. And interestingly, Goldman economists predict the chance of a recession at just 20% over the next 12 months. So it seems more likely than not that we're going to get one of the good reasons for a rate cut and not the bad reason for a rate cut. So, again, if you're going to take the Goldman economists' odds at face value, it looks like 80% chance we get one of the top 2 lines on this chart, only a 20% chance for that red recession line. So I think that's good context. We're certainly not out of the woods yet. But again, the GDP number continues to surprise on the upside. And in fact, a lot had been made back in 2022, the first couple quarters there was the quote unquote technical recession where the GDP number was negative. That actually got revised away. So there actually was no technical recession. Once better data came in, the Fed is always, or the BLS is always revising numbers as they go. And with the revisions, there was actually no technical recession at all. So again, not out of the woods, but things seem to be trending in a relatively positive direction as far as the economy goes and the Fed cutting rates. But this is just talking about the general stock market. How's it going to do? I think we want to take it a step further and ask a question: how is the Fed cutting rates going to affect our strategies more specifically? And so for this, we actually looked back at the 5 most recent rate cut regimes, and we looked at the first rate cut in that rate cut cycle, and what we found is a range of outcomes. The main thing that our investment strategy tries to do is predict which size and style phase is going to outperform and lean portfolios in that direction. And so over this time frame, there were, when we did get in a rate cut cycle, there were more pro growth periods than pro value periods. But it certainly wasn't the case that every time it favored growth. So out of these 5 rate cut cycles, 4 of them favored growth, 1 of them favored value. It was even more mixed with regards to size, where we saw 3 pro small cap cycles and only 2 pro large cap cycles. So again, it's definitely not, the Fed's cutting rates. It doesn't necessarily favor one part of the market over the other. We can see a range of outcomes. And I think, honestly, pretty similar to what Goldman found, context really matters through all this. So when we look back at 2001, this was the period where we had value stocks and small caps do well relative to large and growth. We were coming out of a dot-com bubble burst. So we had these really stretched valuations, the large growth side, and so small caps fared relatively better. But then we go to 2007, that was right before the big financial crisis, where you saw the large banks, large value really underperform. So we had pro growth and pro small perform relatively better than the rest of the market over that time frame. Going to 2019, the most recent time we started a rate cut cycle, this was right before the COVID crash, where large growth did very well. We just transitioned to a digital, online society seemingly overnight, and large growth was best poised to take advantage of that. So these things, tend to be highly context dependent. It's not necessarily the rate cut that matters. And so where we are now, our view is that small caps today are more sensitive to the rate cut and just the level of interest rates than large caps, because there's this wall of debt that's coming due in the next few years that will need to be reissued. So if they're refinancing at relatively high rates, that could really put a damper on returns in that space. But if it's lower rates, then perhaps there's more upside there. So I think that's something really to watch. And, as far as context goes with growth and value, we're in the middle of a pro-growth market phase where growth companies have had the edge over value. How long would that continue? I don't know, but generally speaking, the phase that we're currently in is the one that we can expect to continue until we see evidence to the contrary. And so we've been in this sort of mega cap growth phase, seemingly for the past 5 or so years. And while we do expect growth to continue outperforming, we are leaning into small and mid caps as well, really betting on a resurgent for the rest of the market beyond just the mega caps. And we did see some evidence of that in the third quarter. So, this is a look at how each size and style segment of the market did over the past, year and in. And while it is still the case that large growth has the advantage both over the last year and year to date, this past quarter saw the rest of the market participate in the rally itself. So we started seeing small value. That was the best performing segment. We saw small caps, mid caps do relatively well, and large growth was actually the laggard over the quarter. So to us, that's a healthy sign. When you see more stocks participating, there's more market breadth. It's generally a good sign for the stock market. And you may look at this and say, well, it looks like small value did well, mid value did well, large value did well relative to the growth counterparts, and that's certainly the case. We do expect there to be some counter trend periods in the middle of a growth cycle like we are today, but this is something that we're going to continue watching. And if we see continued pro value momentum really sort of take hold, then you might see us begin to make some adjustments in the near term. We're kind of about halfway through, or maybe slightly more than halfway through what we would expect a typical growth cycle to last. So it's something to watch. Now, I did want to say we spend a lot of time talking about factors. We talk about how size matters, how value or growth matters. One of the factors we spend a little bit less time talking about is something called momentum. But I think momentum's been really, really interesting this year, because while we have seen growth outperform year to date, actually the best performing factor has been momentum. And similar to the size factor and the value premium as well, there is robust academic literature and evidence suggesting that momentum does exist in the stock market. And in fact, it's one of the most damning evidence contradicting the efficient market hypothesis that, based on, if we had truly efficient markets, momentum shouldn't matter how a stock was doing in the past to future returns, but we do see pretty robust evidence across various asset classes and countries that momentum does exist. And, when I say momentum, I'm simply talking about the tendency of a stock's price movement to continue in its current direction. There's actually, while we play this factor, but we play it a little bit differently than we do with size and style. So with size and style, we set targets at the highest level, at the portfolio level, and then we fill it in. With momentum, we actually play it at the individual stock level. So we're not setting a momentum target at the portfolio level, but we do like to use momentum when it comes to stock selection, both on the way in and the way out of a stock. And for us, there's a couple different ways that we measure. There's one very simple way, but very powerful way, which is look at the performance of stocks over the past 6 months. If they're in the worst 10th percentile or even worse than that, they tend to continue underperforming. This has been the most consistent signal for us in predicting stocks that are going to do poorly. We actually colloquially call them eyesores here internally because these typically are the ugliest stocks in a portfolio. They're the ones that are down double digits and catch your eye. But there's also a more complicated mix of short-term and medium-term and long-term signals that we use to really give us a bullish or bearish sign on a stock. And we've been running that version of it. We call it our moving average signal. And for that signal, it doesn't always perform the way you'd want it to, but every now and then it performs very, very well. And this is actually one period where we've seen that moving average signal do extraordinarily well. So again, this is the actual performance of these categories of stocks that I just described. You can see where the so-called eyesore stocks year to date have actually lost ground through the end of September. Even though the stock market's done so well, these stocks have lost ground. And there's a 14 percentage point differential between those stocks and the rest of the market. And that's really good. That's really strong, effective performance. And the way that we use this in practice is when a stock becomes, one of the worst performing stocks over the last 6 months, we'll sell it from the portfolio, really no matter what our other ratings say on it. But I think the other thing I want to highlight is this moving average signal has actually been even better. And this one's interesting because it gives us both a bullish and a bearish signal, whereas our eyesore policy just gives us a bearish signal. And here, there's actually been a 21.5% differential between the bullish and the bearish side here. So I bring this up because I just wanted to discuss a little bit how we use momentum and how we implement it in practice. Essentially, we're trying to sell stocks that are eyesores that are in this, bearish moving average tail. And we're trying to buy stocks that are highly rated and exhibiting positive price momentum. So I think this is something that I wanted to clarify on our process, but also something that you can take home if you've got your own investments. Just make sure you're considering momentum as part of your process. And one final thing, we'll mention this at the top, but I wanted to highlight it as well. We are very proud to be ranked number 3 nationally and number 1 in Virginia by CNBC. And really, we owe you a huge thank you for allowing us to be honored in this way. This is a shared honor for both us and you as our clients, because again, it would not be possible without you at all. There's over 40,000 registered investment advisory firms that could be considered for this. There's 800 that met CNBC's criteria. And so this really is quite the honor. CNBC is looking at things like our compliance record, number of years in business, credentialed employees, accounts, assets under management, all that stuff, and it gets put together into a rating. So it's because of you, our long-term clients, that have really made this possible. So again, wanted to say thank you, and I want to make the point that we are taking on new clients. So if there is anyone in your life who you think could benefit from working with an advisor like us in the same way you have, please don't hesitate to introduce us. And with that, I wanted to get to our Q&A. So I'm going to moderate here, and I've sort of grouped these questions together by topic to an extent. So I'll start with this first one, which is the outlook for bonds. And so, Adam, you mentioned this as part of your presentation here today. So I'll let you go ahead and take this first one. What is the outlook for bonds?
Well, just to rewind back to 7-8 years ago, we were in a zero interest rate environment. And, a big part of looking at the future forecasted return for a bond is, what's the yield? And then how much buffer do I have in my fixed income portfolio if rates ultimately fall in the future? So there's a yield piece and a price return piece. And at that time, our outlook for bonds was really not all that great. In our asset allocation models, we had minimal bond exposure relative to other things like equities and alternatives. And that has certainly changed based on where we are now. Rates are higher. So bond investors on a forward-looking basis are getting more, definitely more yield. And then in the event that rates fall in the future, whether it's through rate cuts or we have a recession and rates need to be cut, there's a lot of room, for rates to come down. And when that happens, the price of return of bonds, goes up. So bond investors and the forward outlook for bonds as a whole is definitely better than it was. It's possible. It's more likely than not that you're going to see what's happened the last 30 years on average, with rates just continuing to come down from a really high point. But bonds now are more attractive in the context of a diversified portfolio than they were. Our asset allocation models now reflect that. In the most recent round of changes we made a couple months ago, one of them was, hey, we're more comfortable now holding bonds in our diversified portfolio, so we increased that exposure a little bit. And so the kind of pain that a bond investor has seen a few years ago is hopefully going to be subsided by a better forward-looking outlook.
Yeah, that's great. Got nothing to add there. So I'm going to keep things rolling. We had a few questions come in about the effect that elections have on markets. So I know, Adam, you mentioned it, but I'm going to go ahead and maybe take this first one here. Since, Bijal and I did that webinar back at the end of August. Again, I'll suggest that anyone here who's interested in learning more about how the election impacts markets, it's a quick, tight 30-minute presentation. It's on the resources side of berniewealth.com. You can just toggle for webinars and find it pretty easily. And I think some of the surprising things that we found and that we show in that presentation is that elections actually have very little impact on the stock market. It's just one piece of the puzzle that goes into overall stock market returns. Probably the more important things are, how's the economy doing? That's really kind of like the top issue here, and elections are only one small part of that. So what we've seen in the data is that there's really no difference during an election year, after an election year, what political party is in favor, whether there's gridlock, whether it's single party control. The US stock market anyway typically marches higher, no matter what the political situation is. And so that's going to somewhat impact, this question that came in about what strategic changes that we might have as part of the upcoming election. We're really not doing anything different in our investment portfolios. I think the thing that we're watching more closely is the Fed and their interest rate decision and how that might impact, size and style. But again, that's more the story about the economy than the actual election. That being said, and not on the investment side of things, there might be some things to watch with this election. I'm thinking specifically as it relates to estate tax exemption. So Adam, this is something that you have been watching closely and work closely with clients on. Can you talk a little bit about possible changes as far as estate tax law goes?
Yeah, there's a couple really big things that are going to be a coin flip based on what happens to the election. Obviously, in 2019, we had the Tax Cuts and Jobs Act, which was the largest tax code overhaul since what Reagan did in the late 80s. So it was a broad and wide swath of changes, and those are due to expire at the end of 2025. So things like the QBI deduction for small businesses, the progressive tax rates, were adjusted at various levels. We had the certain tax credits that were rolled out. So there's a lot that can happen from a tax policy standpoint. I think it's probably fair to say, it's a base case that if Trump wins, those will get at least extended or up for consideration to be extended. And then if Harris wins, they've been vocal about the fact that they would probably let those just expire and maybe try and do something else outside the makeup of Congress. So that's something that, in terms of looking at your personal situation and communicating with your advisor, outside of just, the markets, like Andy, you and Beechel reaffirmed in your webinar, taxes are something we might be able to, help plan around and be proactive about depending on what happens. So more to come there, but watching the what happens with the Tax Cuts and Jobs Act is really big. And as part of that too, the estate tax exemption now has been really significant and growing over the years. You can gift, 28, 29 million between husband and wife, between spouses, pretty much tax-free from a gift and estate perspective. That is due if the Tax Cut and Jobs Act expires, that's going to get cut in half. So a lot of argument around what to do with estate taxes. I'll say this, that estate tax only makes up about 2% of the IRS's tax revenue. So it's really never been a big revenue generator, but it always is a topic of discussion because it impacts, because of the social divide related to it, the ultra wealthy versus everyone else, especially with the exemption where it is now. But if it does get cut in half, a larger bucket of our clients is going to be impacted by that. So there will be estate planning ramification for those with a smaller exemption amount, and things like certain trusts or lifetime gifting, things that might not have been super urgent before will be definitely more important to consider.
And Adam, let me just add to that, that there is this window now through the end of next year where you can capture today's estate tax thresholds. Do you want to talk a little bit about that? Because if you're in that 15 to $30 million like window there, there is action that you can take to lock in the current higher threshold.
You absolutely can. Yeah, those are the estate tax exemption amounts are not backward looking. So if you do something now, you're not penalized in the future if things change. So if you do fall in that camp of either being on the border or you're above the current exemption amounts, things like outright transfers to trust or family, or certain charitable trusts, there's a lot of things you can do and look at and to freeze that higher estate exemption amount and avoid that really punitive 40+% federal estate tax on top of any state or inheritance taxes, depending on where you live. So yeah, for those that are above the current exemption amount, absolutely. We've been trying to have proactive conversations with those clients, but you are in that camp and haven't looked at that yet. We're happy to help you do that and have that conversation. But you've got between now, really in the end of 2025, barring any election surprises, to freeze in the current generous exemption level.
Awesome. All right, I've got just two more questions here relating to the elections. We'll knock those out, then move on to other topics here. But this one was about being fearful of how the election will impact retirement accounts, any advice. And this was one of the surprising facts. It was actually surprising to me when Beach and I put together our webinar. I've always heard and operated under the assumption that elections create volatility. You hear it all the time, where expect market-related volatility into November or shortly after the election. But I believe it was U.S. Bank looked at volatility specifically in all these different timeframes in and around an election. And what they found is no difference in volatility during an election year versus any other year. And if anything, there was actually slightly less volatility during election years. So there's all this, elections are emotionally charged, I think, especially with the level of partisanship in this country today. There's teams and there's people rooting for certain outcomes. And if you get your outcome, you're ecstatic. If you don't, you're despondent. But really, this has very little impact on financial markets. So I think that that's going to be sort of the main takeaway, when it comes to our take on how the elections are going to impact returns. Just expect the stock market to behave like it normally behaves.
And Andy, let me just add also, just kind of a truism for time. If you're a little bit nervous about something in the market, that's probably a healthy market. That's normally a good sign. The time where you're past worry and everything seems great, that's the type to worry in terms of a performance, other shoe dropping down the road. So it's, I always look at nervousness as actually on an overall basis. It's a pretty healthy thing for the stock market.
Climbing a wall of worry, right?
That's right.
Well, on that This one's sort of related to the to that topic. Someone here is asking about the outlook on short and long-term global economy, given political tensions and specifically the China tariff discussion. So I'll throw this one to you, Lowell. Do you have any thoughts on that?
Yeah, I get the easy one. Thank you. Appreciate that. Yeah, and most of us haven't lived through a time like today, um, really kind of ever. I mean, this is like the whole world kind of blowing up, and we don't really even have the biggest threat yet, which would be China, Taiwan, being in full flame. So there's a lot of potential risks around this. Adding the talk about tariffs, which I think is really maybe the main point of this question. That's a really big difference between Trump and Harris in terms of what their positions are. Trump has been anti trade deficit, pro tariff since way before he was in politics. Ted Rosenberg, my first boss here, my predecessor as president of the company, had exactly the same views on the trade deficit and the use of tariffs, to affect that. We have 4 years, of sort of evidence if Trump is elected in terms of how he's going to use it. And he had an interview yesterday with the editor of Bloomberg that I listened to that was, heavily focused on this because, most business people are anti-tariff. And then, of course, Trump is very pro-tariff. He uses tariffs and pretty much to a pretty positive effect as sort of a threat to get his way. He'll threaten something even outlandish. And then maybe he'll actually use a tariff, but in a toned down way to affect some sort of change. So I think as long as tariffs are being used by Trump in a second term, the way that he used them in the first term, I don't think it's going to be tremendously disruptive to world trade. If what he's posturing turns out to be what they really do, yeah, that's going to be a really big and probably negative sort of thing. Trump would disagree with that assessment, but most everybody else would say, yeah. But there, he talks about this in his book in terms of his negotiating style. There's a lot of posturing, a lot of outlandish, that he uses to effect. And I think the extremes that we're hearing with the tariffs are probably more that than what would likely be the reality. And of course, Harris doesn't have any plans along those lines at all. So I would say one or the other, it's probably going to be okay the way this plays out.
Yeah, Lowell, I throw you these hard kind of global macroeconomy questions because I know you spent a lot of time reading up on this stuff and researching it. So I'll give you one more hard one before we move on to other things. And this is about the national debt. The question is, how sustainable is our current long-term spending? I think we know how you're going to answer that question. And what's the effect on the market going to be, in your opinion?
Yeah. So, no, the real simple answer to the first part of that, this is obviously not sustainable. In my view, this is a political view. I think this is a mistake that both parties make in pretty much equal measure in terms of disregard for the long-term effects of this. In the short run and intermediate term, it doesn't matter at all because we are the world default currency. And as long as we are the world currency, we can print money indefinitely, and it's not going to have an effect economically and from an investment standpoint. As soon as that changes, then there's an enormous risk to the way that we've been spending. And this is, this is kind of a sign of a great power kind of later in their life cycle of being a great power. This is a very common sort of phenomenon where the spending kind of gets carried away. And until we as voters decide that this is important and we elect politicians that treat this as important, fortunately, I think we've got to expect more of this problem through time.
Yeah. Something I wanted us to address head on, probably goes beyond the scope of what we're capable of doing today, but appreciate that answer there. So I'm seeing 4 questions left here. So we'll get moving on them. So thoughts on future rate cuts by the Federal Reserve, the jobs market, stock performance, recession possibility. So this is I'll go ahead and handle this one, and Lowell and Adam, if you have anything to add afterwards, feel free. But since I covered it in my part of the presentation here, I'll just give you my take on it. It's going to really matter, what we don't really know today, whether the Fed is cutting rates because things are normalizing, or just a growth scare, or if it's a recession. I think those are the three categories, and I think it's a pretty good framework for thinking about it. If we do get recession as the reason for it, then okay, fine, that's probably not going to be great for the stock market, though it doesn't necessarily mean the stock market's going to fall. If you just look back at the past 4 times that's been the reason, we've seen negative stock returns over those time frames. But I still do think it's more likely than not that that's not going to be the reason why the Fed is cutting rates. I think, if you look at the U.S. economy and its performance, the U.S. consumer has been pretty incredible. The job market, is the unemployment rate's been hovering right around that 4% level. So certainly nothing alarming. Jobs continue to be added, as we just saw in the most recent jobs report. GDP numbers have been relatively strong, and we've seen stock performance kind of reflect that. Stock market's near and at all-time highs, currently. So I don't think there's any reason to be spooked at all that the Fed's cutting rates. Again, as I mentioned earlier, Goldman only sees a 20% chance of a recession, which means it's more likely than not, if we take those numbers at face value, that we're going to get one of the good reasons for why the Fed cuts rates.
Yeah, and let me just add that that you need to keep in mind that recession is something that you measure with hindsight, right? You go through 2 quarters of negative growth, and after that, you can say, yes, we were in a recession. The market decline related to a recession will have occurred before the recession occurs. And so you kind of you need to have a really, really good long-term crystal ball in order to be able to use that effectively in your investing. Because once you're in a recession and you're in a recession, the market's rising at that point. The market rises through recessions and declines ahead of them. So, and it's maybe the most powerful evidence that the recession risk is not that high right now. It is the strength of the market, because the market does that forecasting, and collectively, it's a pretty good forecasting tool when it comes to predicting recessions.
And
Well,
probably
do you think?
Oh,
yes,
go ahead.
right. Go ahead, Adam.
I was going to say 2 additional wins behind the sails of everybody right now. It's just, to relate to the job market, kind of demographics in a large degree are on our side. We've got, you've noticed this the last couple of years, but the unemployment rate hardly budging during a really aggressive rate hiking cycle. I mean, part of the resiliency of the economy, it's been just like the strength of the labor market and the shortage of workers. And the other element of this has been, since the bottom of the pandemic, just the trillions of dollars that households have added to their balance sheets. Your average American, I know there's a lot of talk about disparity between, the top of the income bracket and the bottom, but on aggregate, your average American family in a lot of ways is through home equity gains and just general 401k market performance is in better shape now than they arguably have ever been in. So I think just the way that we've navigated through those two pieces are people are very well equipped to weather an economic slowdown.
Yeah, it certainly seems that way. I think a good question to ask here, Lowell, maybe you have some thoughts on this. Does any of this impact our investment strategy?
And then related to that is the gold piece. So yeah, so the I guess the short answer to that is not really. I do think that there's evidence in that previous chart that Andy has, and there's kind of an intuitive aspect as well, that as rates decline, that should favor growth stocks. And we saw that, I think, in 4 out of those 5 periods historically. A growth stock's valued based on future economic performance, not the right now economic performance. So the lower the rate, the more valuable that longer term economic performance is. So it kind of makes sense, and we see some evidence that is something that we use. So that is something that we'll consider in that process of making a decision. But really, more than anything else, we're looking at the historic cycles, how long of a run, what are the valuation differences, where's the current momentum. Those are the big parts of how we position with respect to size and style. But interest rates do have an impact, especially with respect to positioning value versus growth. And then gold, as I thought I saw gold as a question. Was that a
Yeah, it's
different
at the end of
question?
this question here. Yeah, as
Okay.
an asset class, should gold be considered?
Yeah, should gold be so? So gold as a long-term asset class has an expected return and a historic return that's basically equal to inflation. So it's an excellent inflation hedge. It always has been. Like if you could go back, 200 years, gold was an excellent inflation hedge. It was held for that reason. But gold used to be a stable asset class. So you had both the advantages of basically a store of value and then stability. And now gold has become more of a traded asset. So now you've got a lot of volatility that comes into that asset class, but still have just that same, on a real return basis and adjusted for inflation basis, you have a zero forecasted real return for this asset class, but you have volatility. So it's been a lot less attractive as an asset class over the last 50 years than in all the years that were ahead of that. But this inevitably comes up after gold has one of its runs, and it will have runs, and we've had a run recently. So, we are looking at this, but it's going to have a difficult case making our models because we need that diversification benefit to be enduring. And we need, and there's a big performance sacrifice that comes with this asset class versus everything else that's in the portfolios right now.
Yeah, and gold is as you can probably guess from that answer, not currently in any of our asset allocation models, but we did see some changes to our asset allocation models earlier this year, really in anticipation that the Fed would cut rates. So, Adam, can you just run us through real quick what changes we made there?
Yeah, there's a really a pretty long blog post on our website at berniewealth.com about the asset allocation changes, generally the history of our models, what asset classes we started with, and how it's evolved. I mentioned earlier one of the changes we did make was to increase our allocation to fixed income based on where rates are today and their more positive forward-looking outlook. That was a big one. A second was how we shifted amongst domestic versus international equities in our asset allocations. If you think about the world stock market, and if you added up all the stocks globally, about 65% are of the global market cap is in the US, about 35% is overseas. So if your global equity mix is different than that, you're either overweight or underweight. We were about 70-30 US international. We felt more comfortable sitting around 80-20. So we still are believers in the benefits of long-term international investing. We just reworked that allocation to reflect kind of where things are today and the continued strength of the U.S. economy. So that was the second big change. And the third was the continued involvement of alternative investments in our portfolios. Those in 2022 who had the typical 60-40 stock to bond retirement portfolio, they saw their portfolios drop 15-20%. It was a really, really rough year. And you didn't get the kind of balance from bonds that you did historically. So we have been consistent believers in the value of alternatives because these are, in many cases, uncorrelated assets, meaning they don't move along with the stock and bond markets. And there's also a positive return element to them. So you don't sacrifice a whole lot of return, but you pick up this really nice diversification benefit. So we did, amongst private credit, specifically beef up our alternative investment allocation. So those were some of the high level changes. And again, depending on the risk level of the model, those were tweaked a little bit differently. But that blog post does a great job of discussing that and talking with your advisor specifically. I know we got a question about retirement and volatility in the markets. That's a great point to talk to your advisor about. Hey, am I taking the right amount of risk, or any of these other models more appropriately for me?
Got it. All right, we've got 2 questions here left. Lowell, real quick, what's our size and style forecast? Oh, Lowell, you might be on mute.
All right, sorry about that, everyone. Yeah, we've got tilts towards mid more than small and tilts towards growth currently in place. They're relatively modest tilts. And I think that a lot of the performance success that we've enjoyed this year has come from the stock selection piece. So we've got, really all three of those variables in play at any given point in time. And the big variable that's been beneficial this year has been the stock selection part of what we're doing. And that's a nice segue into BRNY, our ETF. It's been our best performing strategy. And I'll just give a little history of this. So we have our models are kind of a term that's used as fundamental. It's a long-term fundamental based persistence modeling process. We call it SCORES, our name for it. We've been running something like that for 50 years. We're really pioneering in the use of quantitative methods, which today could be called machine learning methods to understand where investment opportunities are. And that has been a very strong part of the foundation of the Bernie Company for its existence. We have another rating that we have been using more recently, and I'll say 7 years, maybe 8 years, where it's a different firm's model. This is more a current version of machine learning and unconventional data, where it uses that information and that quantitative technique to identify companies that are going to have positive and negative earnings and revenue revisions and surprises. And it's very effective at identifying those. So first couple of years that we had access to that rating, we really didn't get much of a performance adjustment to that, much less than what we were expecting based on our analysis of it. And it turns out we just weren't trading it enough. This is a signal that will change potentially radically quarter to quarter for every single company in the stock universe. And to take real advantage of that, you need to have fairly unconstrained turnover, which is another way of saying it's very tax inefficient. So for 5 years or so, we've been running that strategy just in our tax advantaged accounts. It's been our best performing strategy for that period of time. And that's what motivated us to launch that as an ETF, because inside an active ETF, and BRNY is the ticker of our active ETF, you have full tax efficiency almost all the time. You have to always put a little caveat on it. But the way that we're going to run this, it's baskets of stocks get exchanged on a tax-free basis instead of buying and selling stocks in them. Even though we're trading heavily every single month that portfolio. So you've got this. Really, it's just a tax efficient vehicle that we put a very tax inefficient but best performing strategy into, and it's been doing remarkably well. It's continued the performance of the base strategy for the 2 years that we've had it. It's hard to benchmark this because, like all of our strategies, we're going to adjust big to small, value to growth over time. Right now, Morningstar has us categorized as a mid blend, and we're off the charts good with that category. But advance the clock a year or 2 or 3 years, and we could be a large cap blend or even value or growth based on how they do that. I'd say the big difference between our ETF and most other ETFs is this is designed to be the single allocation for your U.S. equities, period, dot. And if you think about the responsibility that we've had for the last 50 years, generally clients have come to us, they've given us all of their U.S. equity investments, and they want us to build a broadly diversified portfolio, not a niche portfolio. So this is designed to be that one portfolio that we will adjust through time, that basically you can just step back and just let it grow, and let it grow on a tax-free basis. And I wasn't going to mention this, but I will, just because I can't help myself. We have another version of this where we have, and some of you on the call might be invested in this strategy. It's a 1-30-30, where we take this, the BRNY is the long part of that portfolio, and just describing that. If you have $1 million account, you put 1.3 million into the long position, and then you sell short 300,000. I won't, if you're interested in more details, please talk to your advisor about those. But the reason I mention it is from a tax standpoint, you get this tax-free growth on the long side, and then on the short side, you're harvesting losses. So you get, like, for the past 2 years, we've run it with BRNY is the long. We've run the strategy for 8 years. We're in our 8th year, but we've run it with BRNY as the long for 2 years. And for those 2 years, we've had this beautiful thing where you get this great growth of the portfolio and these tax losses that, you know, that you can kind of generally expect forever. When the market declines, we'll actually get taxable gains during like the 1 year and 5 where the market's sells off, but like probably the rest of the years, you're going to get some degree of tax losses to use. And then, of course, as a legacy vehicle, you know, eventually this passes to your heirs with the basis stepped up. So it's a really cool, maybe, you know, kind of the ultimate example of what we can do for you to maximize after-tax return.
I was actually going to prompt you.
Sorry, Andy and Adam.
I was
I promised not to do that. I did it anyway. Sorry.
In our pre-webinar prep meeting, we did mention this, but I was actually going to prompt you to talk about it despite that. So I'm glad you went there.
Okay.
You know, BRNY, we actually just passed our 2-year anniversary over the weekend. You know, so there's a history, a track record. You can go back and look. You know, but we're proud to say that we've launched it and we've been running it for 2 years now. That's the end of the questions that we had here. So I just wanted to thank everyone for joining us. Again, big thank you to everyone. The CNBC honor is a shared honor with us and you. We couldn't you know, get that without you, our clients. So big thank you to everyone, and thank you for joining us.